Okay, let's dive right into this explainer. We're unpacking a macro shock that is literally splitting the world's most critical technology market right down the middle. We are witnessing the great AI chip divergence. On one side, we have Nvidia, a company riding the largest technological wave in history. And on the other, we have Huawei, a company rapidly engineering a parallel technological universe out of pure necessity. This isn't just a regular corporate rivalry, you know? It's a fundamental structural shift in how the future of computing is actually being built. Here is our roadmap for today. First up, the fracture. Second, the silicon battleground. Third, building the walls. Fourth, the financial reality. And finally, two parallel universes.
Section 1. The fracture. To understand the sheer scale of what's happening right now, just wrap your head around this number. Nvidia's cumulative order visibility through 2027 is a staggering $1 trillion. This astronomical demand is exactly what drove their record fiscal year 2026 revenue of $215.9 billion. That's a 65% year-over-year jump. CEO Jensen Huang sees an absolutely insatiable global appetite for their upcoming architectures. Globally, Nvidia is practically the undisputed king. But as we're about to see, the word globally comes with a massive asterisk.
Because, get this, before success of U.S. export controls really kicked in, Nvidia controlled practically everything in China, about 95% of the AI GPU market. But by 2026, analysts project that share is going to plummet to just 8%. Even their downgraded compliant chips face strict export blocks. That is a massive, sudden vacuum in one of the world's largest tech economies, and it actually forced Nvidia to book a $4.5 billion inventory charge.
So who fills a 95% void? Well, nature pours a vacuum, and so does the tech market. While Nvidia dominates the rest of the globe, Huawei has captured this newly isolated Chinese market. In 2025 alone, they shipped over 800,000 Ascend chips. That secured them almost 50% of all domestic AI chip shipments in China, making them the largest domestic player by far. The market fractured, and Huawei stepped right into the breach. Section 2. The Silicon Battleground.
Now, the crucial point here is raw compute power. Nvidia's Blackwell B300 hits roughly 15 petaflops in lower precision formats. Huawei's current 910C, it's sitting at around 800 teraflops. So we're talking about Nvidia offering anywhere from 3 to 15 times more raw compute. Now, Huawei upcoming Ascend 950 is aiming to double their performance, which would place them somewhere near Nvidia's older H200 class. But even still, Huawei remains roughly a full generation behind in raw performance and memory bandwidth. And this brilliantly illustrates a story of constraint versus scale. Why does that performance gap exist in the first place? It's all about manufacturing nodes. Nvidia gets priority access to TSMC's cutting-edge 4-nanometer processes. Huawei, restricted by sanctions from accessing advanced lithography equipment, has to utilize SMIC's older 7-nanometer class nodes. Because they literally can't shrink the transistors any further, Huawei is forced to rely on intense system-level innovation, like actually bonding two dies together in dual-die packaging, just to try and bridge that gap.
Section 3. Building walls.
So if Nvidia's chips are really that much more powerful, why is Huawei so successfully capturing the Chinese market? The answer lies in their highly distinct competitive moats. Nvidia's moat is entirely market-driven. Developers don't just write code for a generic GPU, they write for CUDA, Nvidia's software ecosystem that they've been building up since 2006. Once you build your AI on CUDA, the switching costs are absolutely enormous. Add to that a proprietary networking stack, NVLink and InfiniBand. That alone generated $46.7 billion in fiscal year 2026. Nvidia doesn't just sell you a chip, they sell you the entire interconnected data center, locking customers in through pure performance and convenience.
Nvidia also aggressively compresses the window for any would-be competitors. They've shifted to a grueling one-year product cycle. They went from Hopper straight to Blackwell, and by 2026, Vera Rubin will enter volume production. Essentially, by the time a competitor catches up to today's standard, Nvidia has already moved the finish line. In stark contrast, Huawei's moat is geopolitically enforced. Because of strict export controls, massive Chinese hyperscalers like Alibaba, Tencent, and ByteDance simply have no choice but to adopt domestic alternatives. This gives Huawei a massive captive market of around 4 million AI GPUs per year. To support this, Huawei is building an end-to-end indigenous software stock called CAN to rival CUDA. It's not a moat built purely on having the absolute fastest chip. It's a moat built on being the only legally viable, high-scale option available to an entire massive economy.
Section 4. The financial reality.
When we look at the bottom line, the gap in profitability is dramatic.
Nvidia is operating in this hyper-profitable reality, boasting a net margin of roughly 54.2%. They are practically printing nearly $100 billion in free cash flow every single year. Huawei, on the other hand, operates as a highly diversified tech conglomerate. Their AI chip business is likely operating as a strategic loss leader right now, and that makes sense given the massive fixed costs of domestic R&D and the lower manufacturing yields they're dealing with. Nvidia is optimizing for maximum global profit, while Huawei is optimizing for strategic domestic survival.
Now, you might be wondering, why do global companies keep happily paying Nvidia's sky-high prices? Well, while Chinese alternatives led by Huawei offer a 30 to 60% lower total cost of ownership, or TCO, operators still willingly pay Nvidia's premium. Why? Because systems like the Nvidia GB200 deliver absolute AI factory profitability of around 78%. Nvidia's hardware generates massive, immediate revenue for the companies deploying it, which makes that huge initial price tag totally worth it for global hyperscalers.
Let's talk valuation for a second. When financial analysts look at these companies, they use a metric called WACC, or weighted average cost of capital. Essentially, it's a measure of the risk investors price into a company. When assessing Huawei's valuation, we absolutely have to factor in a high geopolitical risk premium to their WACC. Unlike Nvidia, whose demand is driven by an organic global market frenzy, Huawei's demand is heavily policy-driven. They face the constant, looming risk of further sanctions or supply chain blockages, which makes their financial future incredibly difficult to predict using standard models.
Ultimately, this means Nvidia's primary risk in a standard discounted cash flow valuation is simply whether global AI hypergrowth slows down. If AI spending cools off, Nvidia's sky-high valuation might compress. But for Huawei, which, remember, remains privately held, valuation is highly uncertain due to entirely different sensitivities. They are burdened by the constant threat of further technology blacklisting and the severe uncertainty of SMIC's manufacturing yields for those critical 7-nanometer chips.
Section 5. Two parallel universes. Bringing it all together, the reality is that these two behemoths are not actually competing head-to-head in a single arena anymore. Nvidia entirely dominates the global market with a self-reinforcing flywheel of unmatched hardware and deep software lock-in. Meanwhile, Huawei is strategically carving out China, surviving and scaling through intense system-level innovation in a completely indigenous supply chain. They're essentially two different kings ruling two entirely separate kingdoms.
But Huawei's road ahead is definitely steep. For Huawei to actually remain the most credible challenger in the long run, they absolutely have to overcome three massive hurdles. First, they need viable manufacturing yields from SMIC so they can actually produce enough chips. Second, they must develop competitive, proprietary, high-bandwidth memory to feed data to those chips. And third, their canned software ecosystem has to reach a critical mass of developers, so it becomes self-sustaining, much in the same way CUDA do. Which leaves us with this final fascinating question about the future of global technology. Right now, Nvidia and Huawei are building isolated tech stacks with totally different architectures, entirely different software platforms, and separate supply chains. So what happens to the world's most vital industry if these two universes never actually reunite? Will one eventually overpower the other, or is a permanently bifurcated tech world just our new reality? Take that thought with you. Thanks for joining me on this explainer, and keep questioning the data.